Good morning, ladies and gentlemen. By my calculations, we are back into the 50s, so the risk dial is actually positive, indicates to prefer equities to bonds, which is really no surprise. This week we have the Fed, and what we need to do is understand what their motivations here might be. We have lots of speculation that they might want to stop the upward move in yields for a while at least. So let's try to understand what the motivation is and what the yield curve implication might be, because those will drive all other asset prices. Since this week we had the ECB, and since I'm certain that all these central banks talk to each other, and we've seen this trend from the Bank of Canada, from the ECB and others, of trying to calm much higher yield expectations, it would be logical that the Fed would try to do something similar. So let's examine what the responses were in the European bonds. And this is the Schatz, the 2-year note, which basically closed the week absolutely unchanged at its very important 191, 192 level. On the weekly charts and the monthly charts, I won't show you two in the monthly because there's no point, you know what it looks like. The 5s and the 10s had a slightly better time. They gained about 20 basis points, and so did these the bunds, and so did the 30s, which actually came down from around 242 to 207, 210, probably en route to this 180 area that is so important. Why did that happen? Okay, so I think what happened, and it's counterintuitive, is that a lot of people said, right, they are going to try and limit the upside. Therefore, I want to buy some duration, some longer term bonds, because in the longer term, they are trying to set a ceiling for the for rates, and therefore the next move is going to be either sideways or down in yield, and therefore buying duration makes sense. Possibly the wrong response, because they have not, and the central banks are being very clear. What they're saying is correct. Monetary policy has big lags. They have tightened a lot over the course of the past 9 months, and therefore a period in which they fulfill what they promised, what would be the terminal rate, and then they wait and see what the data is before deciding what their next move. All that does not imply lower rates. It implies that rates will be fixed or stickier at the terminal rate, i.e. the reason for them to move higher has a higher bar, i.e. the data that comes in needs to negate what they are thinking about the temporariness of inflation and how quickly inflation will come down, and or the how unemployment will evolve. But that does not mean that if the data does not support it, they will not hike again. It means precisely that the data has to make them hike again, and that is not a great reason to buy 10s and 30s. It's more a reason to sell puts in the 2s and 5s for the time being. And that is what I will continue doing if the Fed comes out and says what what I expect it to say, which is basically that terminal rates are going to go to the 475 area, just shy of 5, and the bar for them to take it through 5 would have to be necessarily a bit higher than the market expects. That does not mean that the twos fall out of bed. That does not mean a huge rally in the 30s. It just means that some people will adjust their portfolios to buy some more duration, but I don't think that that will be a long-term effect. So probably expect very much the same kind of price action in the US as we had in the ECB. So now let's have a look at the US. The trading in the US last week was very much similar to what happened in Europe. You have 2 years down 9 basis points, 5 years down 18 basis points, and the T-bond basically down 16 basis points, with the ultras down the most. Just short of 20 basis points, 19. So I would expect the twos, if the Fed does come out and say that they would like to slow down the pace of hikes in December, i.e. go to it for a 50. So do a 75 now, go for a 50 in December, and then try to wait with a higher bar for further hiking after that, i.e. data dependent, but the data needs to show them that they need to do it. In that case, you would have thought that the volatility in the twos is going to drop substantially. The fives, I'm really not all that sure what the relationship between the twos and the fives should be. I suspect it's going to be much the same as the one we saw in Europe, i.e. people start buying some duration because there will be speculation that we are done. But I think that speculation is just basically wrong. It's not that we are done, is that we are done now. The terminal rate is the terminal rate, i.e. around just short of 5. Why would you want to be hugely long of 5-year notes at 430 unless you're absolutely convinced that the next move, and quite quickly, is going to be down? I don't think that happens. I think it's much more likely that we enter a period of sideways trading in a 30, 40, 50 basis points range, rather than we make significant outright moves. What does that imply for the individual tenures? I would say it implies stickiness. I think any Fed meeting which is taken slightly more bearish than the market expects, unless they say that what the Wall Street Journal wrote and what the other central banks have been saying holds absolutely no validity for them, i.e. they deny everything that we've been trading for the past couple of weeks, any move towards 460 to 475 is going to get bought, or it's going to have, or basically what the market is going to have is a much shallower rate of ascent. And any move down is also going to be very sticky. So could they do a quick ABC in terms of we've got the terminal rate is now set, the next move is down? Yes, absolutely could happen. They could take out the stops below this level. There are bound to be lots of stops and come down towards the 380. But I think that that would be a great opportunity to look for the upside again. As I say, we're entering a period of stickiness, not a period of trending, if they say what we expect them to say. And that basically means that in fives, if you see anything around the 380 to 370 area, it's a great opportunity for put spreads in the futures. Tens, I would have thought that anything around this area, around 370, in 360, will be a great opportunity again to see the fours. It just makes sense, right? First, the Fed comes out with with the same mantra as the ECB, the Bank of Canada, etc., which I've just described to you. What's the first reaction of people? Let's get some duration on board. Excellent. They come in, they buy the duration, they take the individual tenures down to these levels. What's the next move? Well, the next move is whatever non-farm payroll and inflation say. And I've seen absolutely no reason to expect that they're going to say that we are rapidly decelerating in the economy, in which case the market will come back very, very quickly to the same levels where it started the Fed meeting from. Very quickly, because the speculation will then be that it's going to be that we are achieving the bar for higher prices, and there might be, instead of speculating on a 25 basis point hike in January, February, whenever, they're gonna start speculating on a 50 basis point hike. It might be complete rubbish, but that's what the market will do. So I would have thought that at best we will develop some kind of long-term head and shoulders here, but it needs time. I don't think the Fed is about to switch from a huge tightening to letting prices rally substantially. That I don't think is their aim. Their aim is simply to pin rates within a 30, 40, 50 basis points range of where we are now. If we look at the 30s, I would be very surprised if we go through 394. To me, 394 is going to be a great opportunity to look for some level like this, 420. So I really don't think that we have any reason to change our minds as to what is going on. It's a much higher probability that what we are going to see is going to be a first knee-jerk reaction towards higher prices if we confirm what the ECB and the Bank of Canada and the Wall Street Journal have been saying, and then we enter a period of sideways to sticky. What does that imply for the yield curve? Well, it implies that really the first move should be higher, i.e. 530s should reach this very good risk-reward area of around 12 to 17. But the next move should be again down to these kinds of levels. I would be very surprised if we went through the 30s. I don't think that that is legitimate. My preference would be in this kind of area between 12 and 17 to actually build a long 5s, short 30s position, looking for this kind of area, looking down for 19, 20, and that is what I will be minus 19, minus 20. That's what I will be trying to do. Because I don't think that the yield curve will go very far away from flat for a long time. If we look at like 2s, 10s in that case, I find it very hard to believe that we are going to have another leg higher. I think the implications of a steady Fed are, once you've done the original buying of duration, which is the knee jerk that we saw in Europe, why would you be happy to keep a sort of a position at 50 basis points if the Fed is not going to be as aggressive? Because if the data then comes out saying that they need to go higher, then you have the doubts that they will go higher and the yield curve should steepen. And if the data comes out bad, i.e. The economy is rolling over very, very strongly, well, the natural tendency for this will be to come back down towards these kinds of levels, minus 10, something like that. So I think the risk reward in the yield curve, once it's achieved some higher levels, will be to start steepening again. Because I really don't see the risk reward of keeping, of preferring 10s and 30s to 2s and 5s if we're going to be sticky. Your appreciation in the 10s and 30s is not really going to be all that great. So the risk of very, very bad numbers will actually kill you, because the 2s and the 2s and the 5s will start appreciating much more if they start thinking that the next move is actually down. So I really don't see the risk reward of further flatness from higher levels. Once we've had the Fed meeting out of the way and people have bought the longer end, I just don't see the risk reward in keeping flatness on. The differentials between Germany and the US are puzzling me. But let's think about it logically. Once the Fed is out of the way, and once we've had and once the situation becomes clearer, why it always supposing that what we have been trading, the narrative that we've been trading, that I've described earlier, is correct, why would you want to hold German paper over US paper? Well, I don't know, but it's certainly at 202 is the next big risk-reward point. I think that this one is pretty good because the market keeps on trading around it, and as I said earlier, I expect the first reaction to be buy duration, come back down and fill these gaps towards 180. But I'm just puzzled that the market does not want to take this spread down. If we have a look at a monthly chart, you will see how important this 202 level is, because if we start breaking it, we will have broken, best part of 2 years, 18 months trading range. And that might imply, prices going all the way up to 250, 260 at the very least. So, it's something that I'm keeping a very firm eye on, something which is puzzling me, something which doesn't fit my narrative. Because if prices are going to be stable at a certain yield level, why would you accept 200 basis points less? So, it's something to think about and something that I will be very, very careful about over the course of the week. As far as hints are concerned, I think that this chart really says it all. This is the French bond on a daily basis, and you can see how important this level here is, this 247 level. Touched it beautifully, then we had the rally in prices. Here we've never closed below it. Look, how that made me money here, and we bounced right off it on Friday. So I would have thought that a close somewhere around 238 or something like that will actually be indicative that we're going to get a continuation to at least this kind of level, 208 to 210. So that should be our hint for what, in general, rated 10-year notes and bonds are going to do. If we can't break this level, I think the next move is back up towards the highs and certainly fill these gaps and back up to the highs. So I will use this 247 on a closing basis very much as my hint for what's going to happen, my tell. The Dixie did exactly basically what I was expecting last week. I was expecting a weaker dollar down to 109.29. Well, we got very, very close, didn't we? And then, very small muted bounce on Thursday and Friday, and now we wait for the Fed. I think the danger is still to the downside, because if we get a confirmation of what the Fed said, or what the Wall Street journals said that the Fed will say, and what the ECB and the BOC have more or less confirmed, then apart from a knee-jerk reaction of buy the rumor, sell the fact, which might take us to something like 111.80, the danger becomes that people start speculating that that's it, the Fed is done. Wrong, but it's what people do, and then we can actually start coming down towards the 107s. If we have a look at that on a Euro USD, it's still, my levels are still the same. They are this 102 to 103.40. That's the kind of level that you could see it run towards before a period of stability, and then you might even get a change of trend. Who knows? But I still think that the danger is going to be to the downside after a brief period of consolidation, and buy the rumor, sell the fact, and then people get absolutely smashed. That is probably what is more likely to happen than not, and that will actually fit in with my view of the differential between 10-year notes in the US and Europe. To me, it's just illogical that you can have these levels at 2%. Why would you do that? It just doesn't make any sense to me, but I'm probably wrong as far as that is concerned. I think the differentials have to come in, and therefore the dollar has to weaken towards that 103, 104 area as those differentials weaken. Well, gold, what to say? The bonds were doing better all week. The dollar was weaker all week. If gold wanted to go higher, it would have gone higher. It didn't. Basically closed the week very much unchanged. It did very, very little. What did it do on the week? Let's have a look. It actually was down slightly, right? I mean, we closed 149, 145, so like nothing lower. But that doesn't make sense. It should have been higher. And the fact that it wasn't higher is basically, I think, people anticipating that the dollar will go, the dollar will, first move in the dollar is going to be higher, and bonds are really going to be sticky and not move very far away from where we are. So gold is just not buying it. That's all I can think about. And therefore, things which are relatively weak tend to get weaker. I would not be a buyer of gold, certainly not until it starts breaking back above, at the very least, 1764. To me, this is a bearish pattern which can continue. The 200-day moving average is looking down. All the moving averages are looking down. Every time the MACD goes up, the move is pathetic on the upside. Tells me there's quite a bit of, apathy at the very best in gold. I'll show you some relative charts of how it's performing against bonds and equities a bit later on. And you will see really that the attractiveness of gold here is not very great. If gold is not very attractive and we are at this very important juncture, I can show you we've got this 200 day moving average coming down to it. In that case, you can't really be all that bullish for DBC either. I mean, this chart goes back a long time, and really you can see that this 638 level has been touched many times. Have we been lower? Yes, of course we've been lower. We've been considerably lower, but it tends to come back towards it. It's a magnet. It's basically what it decides that gold is worth in terms of a commodity basket. It can go 10-15% lower, 10-15% higher, but basically that is the value. So if gold is unattractive, DBC has to be unattractive too. And as you can see, it never, in the past couple of months, it's never really got anywhere near 26.93. And the danger, I feel, is that it starts falling below 24.39. If it starts falling below 24.39, you're looking for some kind of an ABC all the way down to 20.53, which is basically where we started the year. That would definitely fuel a bond rally, and really would show us that the Fed is right, or would be right, in saying that rates have probably peaked. That would really make the 2-year note and the 5-year note rally like crazy, because everybody would start expecting that the next move is very much going to be down in yields, and that the Fed is actually going to ease. Because if you think about it, that will be a huge sign of demand destruction. I mean, just a huge sign of demand destruction, that we actually close the year at the same level that we open it in commodities. I'm not saying it's going to happen. I'm just saying that closes below 24.39 start you anticipating that this is going to be some kind of an ABC move, which its logical conclusion is at the 50% retracement of this whole thing, which just happens to be very much where we started the year. Would that not be something? Well, if that starts to happen, and if it's going to happen, it's got to start happening in the next couple of weeks, then you're going to have an almighty bond rally into year end, and you're going to have an almighty squeeze in equities. First move is going to be the squeeze. Second move is going to be, oh, why is this happening? And then you might get some really bad data on the economy, something that indicates recession, because this move would have to be demand destruction. I can't see what else it could be. Another reason why gold is really can't do much better is this chart. This is the ratio of TLT against GLD. And as you can see, we are at multi-year lows, which is not surprising because TLT has been a pile of rubbish all year. But these levels basically are saying that it's very, very difficult for gold to do much better than go sideways, because TLT is still so weak. If TLT did better, that will actually prompt a lot of people to switch out of gold. So I think gold is screwed stroke sideways, whatever happens. Because if we start breaking down here, I don't think people are going to buy gold. It's going to be people selling TLT. Where they're going to put the money, well, they're probably going to keep it in cash. I don't think they're going to be buying gold. There has to be a very good reason to buy gold at these levels. And that is why I think, this being a monthly chart, if you can see how far back it goes, if we go to a daily chart, we are, we're basically back to neutral. And if we go to a weekly chart, we are also very, very oversold. And that is why gold, I don't think, can do very much better. I think over the course of the next couple of weeks, bonds are likely to do better than gold. So leave gold alone. It's not going to be a productive asset for the next couple of weeks. Let's start equities by actually looking at SPY over IWM. Very much the possibility that we are starting a downtrend. This is a weekly chart, so this is either we're going to go much higher, or we're going to go to at least these levels, 202 to 193. That's a minimum of 5 to 10% move on the downside. That's a weekly chart. Let's try go even longer term, a monthly chart, and you can see how important these levels are. They go all the way back to 2002. So what we could be having is either just a pause, and this is just normal trading, and you can see how important it was back in 2020 and so on. Every time it breaks, it goes a long way. It goes, basically down to the bottom of these clouds, but the likelihood is here. So both on a weekly and a monthly, this is an incredibly important chart over the course of the next few weeks. Why would Russell do better than the S&Ps? Well, it's probably because the S&Ps are so weighted towards the big companies. But this would imply that the recession that we're going to have is going to be nowhere near as bad as we feared, because you can see that when we in 2020, when we feared that things would get very, very bad, this was a risk off. So now we're talking about a risk on, with Russell outperforming the SPY. And if we look at QQQ over IWM, you will see that we are basically headed on a monthly basis. We're headed to the lows that we were back in 2021 when we had this huge rally. So that to me would indicate that the economy probably is not going to be as bad as people fear it might be, which is supportive of the Russell far more than it is of SPY and QQQ. what are the implications of that? Well, what is really strange is that XLP, XLY is actually trending upwards, and SPY, PSCD, let's take it to a weekly level, is really doing nothing, right? You would expect, if we are in a period of risk on, for these to start moving, but they're not. So I really don't know what to tell you. Even this one, which is RCD over RHS, it's not telling me that we are in a huge period of risk on. You know, you would have expected that this would be started to head to the highs, and that XLP, XLY would start going down. What is this saying? What are the implications of these very strange price moves, with the Russell looking a lot better than the S&Ps and the Qs? I really don't know. I think we don't have, I mean, you can come up with your own narrative. I'm just showing you where the big risk reward lies and where the danger lies. The danger here is at 212, weekly close around here, 209 or something like that. To me, it says 202 for absolute sure. And that is, you know, what's that, 3-4%, which is definitely worth having. That's over 100 points in the S&Ps. So that's what I'm saying. I don't understand why this is happening. It could bounce off here, of course. But we are having some very, very strange charts which are indicating completely different things. To me, this is a continuation chart, RCD over RHS, and that says that the next move is going to be lower. So really what all these spread charts are saying is that we're going to continue to have some very strange move in equities until we start getting risk on in all of these charts. I'm really not trusting any level in the S&Ps, simply because the spread charts don't confirm the direction. I think next week we're going to get a continuation of the squeeze in the S&Ps, but after the Fed. But I really wouldn't trust it, and I will show you why. As we are approaching month end, we can have a look at the monthly S&Ps chart. It really hates being below the monthly Bollinger Bands, and they're actually coming in. So what I think is far more likely than not is that early next month we get a push up to these around 40.20, that's going to probably going to be slightly lower, so call it 4,000. And then we see, because really the likelihood is that we touch this 41.81 level as well and then roll over again. I know that everyone is bulled up for seasonality, and really that is why I bought it at these levels, because I had good risk reward here. Up here, I'm not so sure. I'm not so sure that we have great risk reward. If we have a look on a weekly chart, you know, I think this 39.43 level is going to be very hard to break in the early part of the week. And really, I would have thought that buying put spreads or one-day put spreads or something like that, if we reach 39.43 on Monday, is the overwhelming trade, because I really don't think that we can sustain these levels ahead of the Fed. I think we're far more likely to go into the Fed at 38.61 than we are at 39.43 or higher, unless there's a very good reason for it. but we're not going to get NFP till after the Fed, and therefore I really can't see what the very, very good reason is going to be. To me, 39.43 is a very, very pivotal and important level. There, being short into the Fed and getting out just before the Fed makes perfect sense, because we're far more likely to be lower than high than 39.43. If we have a look on a daily chart, I mean, basically we squeeze the hell out of everyone. And it really makes no sense to me, even if we have a look at the 195, that we're going into the Fed at the top of the Bollinger Bands. I mean, why would we do that? We're just setting ourselves up for disappointment. We are far more likely to be around here, having come back into it. 38.61 to 38.23, that would make far more sense to me than keep on going ahead of the Fed, unless everybody believes or knows that the Fed is going to say exactly the same as the ECB. But to me, the risk reward is absolutely zero. If you don't want to be short at these levels, well, don't be long, because the risk reward is absolutely awful. Funnily enough, it's in the Russell that the risk reward is not absolutely awful at these levels. I think it has room to reach at least this kind of level, where we churned for a long time, which is 1855. So another 20 points, 25 points, which is, let's call it just 1.5%. So I think more room in the Russell than there is in the S&Ps, and certainly more room than there is in the NQs. I think anything around 1700 is going to be very difficult for the NQs to sustain, and I expect them to be probably quite a little bit lower going into the Fed. So what I'm saying is prefer Russell, because you saw last week my S&Ps got stopped, my Russell didn't get even close. So Russell to me is the one that's going to do better. That implies some kind of a risk on move. That also implies that the economy is not as bad as people might fear, but that also has to imply very different things for bonds, i.e. that they are going to be sticky, and no way do we have runaway bond prices, i.e. to the upside in price, downside in yield, because that just isn't that doesn't work with an economy which is stronger than people might fear or have feared up to date. Just doesn't make sense, does it? It's just impossible to put together, and therefore I shan't even try. To me, any kind of move down in the bonds, the levels that I showed you, is you buy put spreads for prices, because I think bonds are going to return to where they came from, and really any kind of move up in the NQs to this kind of 11,700, 11,750, I think is a sell ahead of the Fed. And after the Fed, once you've actually seen what the Fed has said, and we can analyze it and we can rationalize it, that's the time to put on some bigger positions. Certainly not now. And that is, I think, precisely the message that we're getting from the Blue Angels. You know, can we get squeezes if bonds do slightly better, up to 4,000? Absolutely we can. But I think that this is going to cap it very well, and that at some stage we return to, I don't know, 3,800-ish. Basically what it's saying is anything over around 3,600, 3,700 is going to get bought very hard. But that does not mean that we start, rallying like crazy, because I don't think bond prices are going to allow it, and I don't think the economy is going to allow it. So, that there you have it. I think the Blue Angels are confirming that you don't really want to be overly long at 39.40-ish in SPX. You want to wait for the Fed to tell you what they're going to do next, confirm a lot of stuff. And can it go higher then? Yes, it can. 4,000, 4,050, whatever, because volatility is remaining low. And I will show you why that might be. And with low volatility, you get squeezes in prices. And basically, the tell was the weekly close below 30.11, and the fact that at no stage could we recapture the 30s, and we kept on closing below. If you have a look, there's a great big gap here down to 2050, something like that. On the dailies, there's another gap down to here, 2288. I think that we are definitely gonna come down here and fill these gaps. That's, what would that imply? That would imply that we get to that, 39.40s in the SPX Monday, Tuesday. We come back on Tuesday, Wednesday, or before the Fed to below 3,900, and then we actually have some certainty, and that implies that volatility comes down as everybody gets bullsed up for the fact that A, we have certainty, and B, we have the bond yields maybe doing slightly better, as the first reaction is to buy some duration. We get a rally in SPX up towards that 4,000 level, and then that's probably all she wrote. Then the odds are massively to the upside, and it would be typical that we get the opposite of what people expect. Everybody gets long at around the 4,000 level, and that is precisely the wrong level to get long of, because the monthly charts are against you, the weekly charts are against you, and the economy then bond yields start going back up, and you get a massive squeeze in volatility from these levels straight back up towards 30. It doesn't imply that the S&Ps are going to make new lows. It just implies that from that 4,000 or something, but we can actually have a look at what, on a clean chart, what that implies. That probably implies that we can, from these low levels, get up to and fill this gap. That's 4083, okay? So that we could get up to the high 4,000s, and then we get one of those. Boom, all those people get slammed, and we come back to 36.45. That, to me, is my favored scenario, that after a bit, we get a squeeze, and from the squeeze, we get slammed into Santa. That makes far more sense to me than anything else. I've updated this bias sheet with the levels, which I think are very important. What to look for are A, the tell from the OATs. I think 247 is going to be critical. And also to look for this 11-12 area in the 530s. those will be what decides us which way we're going in the individual yields, whether we're going to go to support all these support levels, which I think is probably likely because of the first reaction that we had in the bunds. And then I think if that does happen, we will definitely see this 39.83 and then a break and into the high 4,000s as I showed you. I don't think, could it happen next week? Sure, it could happen. But I think it's more likely to be something that happens mid-November. And that will be your wonderful risk-reward level because you will be to go short. But that will probably be covered in the next video. There you have it. I think everything else is actually, especially gold, is a complete avoid as far as I can see. Thank you very much indeed. Have a wonderful Sunday, and I will meet you on Monday. I think if we get these higher levels, that's going to be very, very interesting for a trade.